Pramod Gubbi, Vice President, Institutional Equities with Ambit Capital, joins us live from Singapore. And Pramod, everyone is wondering that what changed on Friday. I mean, what we saw on Friday was remarkable and magical. Benchmark indices made a roaring comeback.
Yeah, I mean, I don't think there were too many reasons to even speculate on. I guess what you were suggesting in terms of clarity emerging from the PBOC also helped suggesting that it is not actually an intentional devaluation exercise by the Chinese government, which meant that we could see some semblance coming back to currency markets. Beyond that, I think the short-term moves generally depends on flows, and flows have been positive. So to that extent, I guess the markets felt more buoyancy on the back of that.
Pramod, this morning, it's all about what the PSU banks would do after a phenomenal ride all of last week and a 7-step process highlighted by the Finance Ministry. What's the sense that you're getting? Is that rally here to stay? Because what's amiss is asset quality and NPA management. There was no clarity on that, really.
Absolutely. I mean, I don't think there was anything particularly new or exciting about the 7-step process. Capital infusion is helpful, but the larger move is structurally change the way these banks work, particularly the way they've managed, the way the management is incentivized across all structures, top management, middle management, and so on. As long as that remains a hindrance, then we don't see any difference in the competitive base of these banks as a whole. On top of that, I think the legacy issues around asset quality still remain. There hasn't been any sort of ideas coming out on how to resolve the SEB mess, the power infrastructure mess, which forms a large part of the NPAs for many of these banks. So I don't think we would change our view dramatically, except to the extent that we'll factor in more capital coming into these banks and their ability to sort of grow themselves out of trouble marginally so.
That's one part of the story, but the other part of the story is that there is an attempt to fix the lending culture there. The Finance Minister and the Banking Secretary have explicitly indicated that PSU banks will now give ESOPs, they will give compensation bonuses so that they can acquire, so they can get or attract outside talent, and also banks will be given greater autonomy. So what are the chances that structurally and culturally there could be a change?
I think we need a lot more clarity on that. At best, what we've seen is the Finance Secretary coming out and saying that there won't be any hires from the private sector. In fact, they're looking at an internal pool of executive directors to be promoted to the level of MDs and CEOs of these banks. So, if at all there is a move to change the culture of these banks through better incentivizations, better compensation, we need to see more clarity on that. At this stage, we don't have that.
Real estate, no one likes it, but on Friday, everybody wanted to buy into real estate stocks. Has anything changed at all, or we should not read too much into Friday's price action?
Nothing really. I mean, I can't see anything that's changed overnight, nor structurally. In fact, real estate remains on a downhill given the structural change we're seeing in terms of movement of savings away from physical savings into financial savings. After a long time, we're seeing positive real interest rates, positive stock market returns. So this move that we're seeing from the traditional assets, gold and real estate, that the Indian saver was fancying and moving into financial markets is definitely positive from for the economy in general, but not necessarily for the real estate sector.
Standout sector, at least for the month of August, has been the IT sector. The IT index in this series as we speak has appreciated by north of 3.5%. Is the weak rupee doing the trick?
Not yet. I think the weakness in the rupee perhaps in the last few sessions, but overall I think there was some beating down of expectations after the last couple of quarters of relatively subdued results. This quarter was perhaps reinforcing the confidence that maybe things are not all that bad within the sector. So some readjustment of expectations and estimates led to some repricing. In fact, there are a couple of large names like Infosys which delivered significantly better than expected results. So I would think the loss of interest that the sector saw from the investor base in the last couple of quarters, regaining of that has led to much of the rally. Perhaps the last leg or the last few sessions was helped a little bit by the currency as well.
What's the view that you're getting then, Pramod, when it comes to metals? I mean, do they continue to remain a short and avoid, or would you buy into trading rallies like what we saw in Friday's session?
Yeah, I mean, I would generally avoid this sector in a global deflationary environment, particularly if the way China is heading, there is significant scope for importing deflation, and which is not particularly great for commodity stocks, particularly metals. And on top of that, it's not like India has any particularly great advantage in terms of manufacturing efficiency on any of these metals. So, by and large, would avoid the sector.
Okay, now let's look at the 4 and the 5-digit stocks, and endlessly we've debated that what is the future for some of these expensive stocks. So I'm going to really look at Friday's market action for a blue dart. Eicher Motors, Page Industries, Jubilant Foodworks. So even though Indian economy is on a cusp of economic recovery, commodity prices have come down, the theme is that government spending will pick up, and that will augur well for some of the core sectors. None of these 4-digit, 5-digit haloed stocks are taking it on the chin. They continue to chug along, they continue to outperform, and that's where I think a lot of institutional action is still concentrated. And Pramod, I wonder why. Currently Indian economy is on a sweet spot. We are on a cusp of a cyclical and a structural recovery. Yet why market men are chasing some of these classic defensives?
Yeah, I think it's. I mean, all of these are fantastic franchises run by really high quality management teams. Absolutely no doubt about that. But having said that, there is a limit to what you would want to pay for such franchises as well. And clearly, a lot of them are trading at levels which would make most value investors wary about getting in at these levels. Having said that, I think we're also living in an environment where earnings growth is being largely elusive. 80% of the market, there is hardly any predictability of where earnings are growing. I understand the macro holds more promise, but in reality, I think we've seen fairly several quarters now where earnings growth has been elusive. So in an environment where earnings growth is a scarcity, the few ones which actually give you some predictability tend to find itself or lend itself as a safe haven for a lot of investors. I think that's perhaps the best explanation. And also, I think structurally a lot of these stories continue to be good. If you leave aside the price, there's absolutely nothing wrong with these franchises. And the space that they are in also tend to be structurally quite attractive in terms of showing long-term growth potential. So I think the best explanation remains that there are not too many companies which can show predictable earnings growth going forward.
Do you think we should not really look at the aggregate picture? The aggregate picture is looking subdued, but there are a lot of individual companies, individual names which continue to forge ahead, whether it's a Bharat Forge or Infosys. Do you think it's impossible to generalize the earnings season?
Well, not really. I would agree. I mean, India has always been a bottom-up market where certain companies always tend to ignore the macro and tend to perform in a different direction. But those remain a minority. The majority still lends itself for generalization. I think the earnings season has continued to remain weak from a demand standpoint. Whatever little benefit we got was because of input cost deflation, which has flowed through the margins and kept the earnings somewhat respectable. How long that's going to remain, we'll have to wait and see. In fact, the demand situation requires for many of these companies to actually pass on the benefits of input cost deflation by cutting prices and trying to boost demand than retain the benefits through margins directly. But I think it will take at least another couple of quarters before we see any sort of meaningful recovery in earnings, because the demand situation at the macro level, you need visibility of at least a quarter or two before the earnings start tracking the macro recovery.
And Pramod, the currency weakness, that could turn out to be an irritant. I mean, sure enough, it's bound to aid the move on IT sector, but largely per se, that's not good news for the market.
Yes, indeed. I mean, to the extent that it takes away that many points from foreign investors' expected returns from the market, it is not that great, and also might make imports that much more expensive. But we've got a huge tailwind in terms of commodity prices, which form the bulk of our imports. So I guess that may not be much of a hindrance. Overall, I think it may help a little bit, particularly with the focus on Make in India. If we were to get anywhere in terms of manufacturing exports, a little bit of devaluation may not be that bad. And I think in any case, given the stability of the rupee over the last 2 years since the 2013 summer, has been much better than most of the currencies. So there's an element of catch up that the rupee has to do. So a little bit of depreciation, in my view, may not be catastrophical for the Indian market.
Pramod, the region which you represent, which is Singapore, is a very typical India-dominated place. A lot of fund managers, they run India domicile funds. What are the sound bites you are getting from them? Are they getting more and more stock specific? Are they now ready to go down the ladder? Are they of the view that it's time to give large cap stocks a miss and revisit mid caps?
Not really, actually. Given the sort of flows they've had, it's been largely healthy. So they've been busy deploying all the flows into stocks across the spectrum. Incrementally, I would think, in fact, given the outperformance of the mid-cap index over the large caps, incrementally people do see value within large caps. Remember, mid-caps tend to be that much more cut off from the broader economy, and the broader economy hasn't been doing well. So well-managed mid-caps have continued to deliver some sort of results, and that's also reflected in the outperformance over large caps. Large caps are largely integrated with the economy. And if we were to see some sort of a recovery in the broader economy, and given the underperformance and given the reasonably less gap in terms of valuations, large caps increasingly look to be the area that investors are looking at.
So what else is looking exciting right now, Pramod? I mean, where could you make drastic amounts of money in, say, the next 1 year time horizon? Would you bet with the underperformers? Could PSU banks be that one space which is showing glimmer of hope?
Not really. Like I said, I mean, we tend to be fundamental driven and relatively longer term, and hence cater to an investor base which is also relatively longer term in terms of horizon. So besides the trading angle on PSU banks, we would like to see a lot more to believe that they are actually structurally sound businesses which can deliver sustainable and consistent earnings growth. Until now, we would stay away from that pack. Our view on the economy has also been relatively muted, given the sort of some of the changes that the government has brought in are definitely positive from a long-term perspective. But like we've been highlighting, they do bring in some collateral damages in terms of slowing down demand, be it the rural economy or the real estate driven slowdown across the value chain, be it home building products, cements, paints, electricals, flowing down to even short-term supply excess in the labor market, which further depresses consumption. So overall, I think we would remain fairly defensive, focusing on external-looking factors. IT and pharma should be the top sectors to focus on until we see a significant change, or at least signs of some revival in the domestic economy, to be starting to focusing on domestic cyclicals.
Pramod, I want to get your views in on the auto space. I mean, interesting moves there. While on one hand you have Tata Motors, I know you can't talk stocks, but just a general brief of the entire sector, you know, with regards to composites like a Tata Motors, wherein we've seen the China sales get hit, with regards to, you know, what is happening in China. When it comes to the equity market correction, or for that matter, the currency devaluation, etc. Comments coming in from the management saying that China will continue to see some demand slump. And then you have other players like an Ashok Leyland, or for that matter, a couple of these two-wheeler majors as well, or Maruti, wherein demand seems absolutely in fit condition.
Yeah, it's a mixed bag, really. I think if you add Tata Motors into the mix, you also get a sense of some external markets. But I think for Tata Motors, China remains a little bit of an enigma, really. I don't see too many people understanding what's going on there, and hence what's the likely situation going to be in terms of a demand recovery. But having said that, I think given how much the stock is corrected at these levels, it is not so much of a concern that China would remain weak. Remember, part of the issue with JLR's Chinese operations have also been company specific, in the sense they have moved production to locally, and there are issues with that. So assuming just the local issues or the company specific issues get sorted out at these valuations, I think one shouldn't be too concerned about the macro situation in China. However, the domestic auto space is really a complete mixed bag, with the passenger car demand leading much ahead of two-wheelers. Commercial vehicles have also recovered, particularly with the Ashok Leyland. But I think stock price rally there is largely reflecting that sort of a recovery. There are some company-specific changes structurally with Ashok Leyland, which needs to be watched out for further upside. But I think passenger cars remains the one category where we're seeing consistent improvement in the demand. Within that, strong competitive advantages for the market leader, which puts it in a good position from a long-term perspective.
Pramod, I mean, the market reaction is quite amazing. Personalities do matter.
Yeah, I mean, like I said, these are quite large institutions, having been run and existed for long periods of time. So it's unlikely that an individual, particularly in a non-executive capacity, is going to change. But it is good oversight. I think one of the issues in the past has been a lack of independence at the board level to oversee some really large lending decisions or exposure to certain sectors or certain large corporate groups. With a more independent board with credible personalities like these, I think that aspect of these banks should certainly improve. But like I said, there are several other issues. The bank on a day-to-day basis is run by executive management, both at the senior level and the middle management level, where we need to have a completely different set of incentive structures for them to compete with the private sector banks, and engineer a structural recovery. These are small steps, but the reaction clearly, in my view, is a bit overdone.
Pramod, what about the rest of the market? Would you say that the worst for the year is behind us, or do you think this impending Fed liftoff could, still bring about a fair amount of turbulence, and there could be fresh lows for the markets in store?
I think from shorter term perspective, the fundamental continues to remain negative, and in fact, it has been negative over the past few months as well, and the markets have surprisingly held up fairly strongly. And if you look at the technical side of things, I think that explains why the markets have held up. Flows both domestically and foreign flows have been fairly supportive. So going forward for the rest of the year, I think that is likely to remain crucial. The fundamentals are unlikely to improve significantly to support the markets. So it all depends on how the flows continue to support. Domestically, we are more positive. Like I mentioned earlier in this program, that we are seeing a structural shift in moving of Indian savings away from physical savings to financial savings. So I think the sort of money that mutual funds have got, perhaps insurance companies will join the fray as well. That should continue to hold up. That helps because that reduces the reliance and prepares us better for an event like next September, in case we do see some sort of pullback of foreign flows. The domestic flow should help. So on balance, I think you might be right. You might have seen the worst behind, but I don't think there's significant upside either, at least for the rest of this year.
Okay, Pramod, on that note, we're going to thank you. Thank you so much for taking the time out and speaking with us today.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.